Welcome everyone to Ask the Experts. This is a show where people can come on and ask their questions live, and we talk about anything real estate related. And today's expert is Marcin. Thank you so much for coming on. And Marcin's gonna be talking to us about how to invest in the American market as a Canadian. I think this is always a very exciting topic. Thank you so much for coming on.
You're welcome. My pleasure. Thanks for having me. I'm excited about it.
Yeah, so let's start off first of all just a little bit with just a little bit about yourself. Let us know, a little bit about you.
Sure. Bought my first piece of dirt when I was 21 years old, actually in Oakville, Ontario, kind of in your neck of the woods there.
Mhm.
Like so many people, read a bunch of real estate books, thought to myself, this isn't so hard. And all those books were written American, obviously. I was growing up in Canada, so it turned out to be a little different than what the book said. But the thought process was good. So bought, started buying properties early 20s. Got recruited into private equity a little bit after that. Worked on a whole bunch of different stuff: land assembly, limited partnerships, commercial plazas, multifamily, just about everything. I think the only thing we didn't touch was hospitality. So had a really broad spectrum of experience there. A few years after that, broke out on my own. It was a family-owned PE firm, so there really wasn't much more I could do there other than just kind of climb the ladder, so to speak. Broke out on my own, my mid-late 20s, opened up a shop, started doing limited partnerships, syndications. Yeah, I've raised a fair bit of capital, a lot of different channels, Canada, US based. And I guess fast forward to today, mainly focused on multifamily housing, primarily in the Southeast United States. So it's been fun. It's been, a little bit of gray hair. Those aren't, the camera angles. Those are grays. But it's a good experience, and I'm trying to underwrite deals in Canada too, because I'm a Canadian, but the numbers, Canada and US, it's just two types of different investments.
Mhm. That's great to hear. So let's get started with then something very basic and just what even caused you to want to get into the US market? Like, what were you seeing that made you want to get into the US market?
Well, so most recently, my partners and I bought 82 townhouses for the price of, two condos in Oakville. So, the economics, I think the easiest answer to that is price. Now, obviously, COVID has, changed things quite a bit, just about everywhere. But economics is one, landlord-friendly rules, depending on the state, is another, especially contrast to, Ontario or Quebec or Manitoba. The rules are very different. And also people, maybe this is my experience, but I find that the US culture, and again, this is maybe state by state, is that there's a lot more get it done people that I've seemed to be able to find. And, maybe that's just the people that I've run into, but it just feels like people want to do business.
Mhm. Yeah, I think I agree with you with America. It's very capitalist and very business oriented, very entrepreneurship oriented, the country, I feel like in general.
Yeah, yeah, yeah. And it's like that in Canada. So I mean, whether it's on even, and this is reflective on the capital raising side or on the finance side, in Canada, it almost feels, and this isn't a generalization, but sort of my experience, it almost feels that sometimes people are looking for reasons not to do deals, whereas in the US, people are just trying to find ways to do deals. Or if they can't do a deal, they'll hook you up with three other people that can get the deal done. Whereas in Canada, it's like, well, so that's been some of my experience, and I've again, I don't want to overgeneralize, but that's just been my experience to date.
Mhm. So you touched on that there's different states and
Hmm.
you invest in specific states. So what are the criteria that you look at that makes you want to get into a specific state to invest?
Sure. Well, the most, as you know, Diana, the most important thing in investing is not the return on investment, it's the return of investment. So you want to invest in places where you could obviously get in and obviously be able to, get your money out. So one of the biggest criteria for me, obviously, is landlord-friendly states. That's huge. Another major criteria is just the basic economics. So, for example, I'm not going to trade one, high-priced market for another high-priced market. In the U.S., there's markets where it's just like Canada. You're priced. You're trying to do anything rental-based, you're priced right out of the market. So that's a big one. Migratory patterns is a big one as well. So and this was pre-COVID. My partners and I started investing in Tennessee, Memphis specifically. And we went there because you had, and again, nobody could have predicted COVID, but we went there because you had this huge logistics hub. You had UPS there, you have FedEx, their global headquarters. Nike has a huge presence there, a lot of different hospitals, a lot of research, just a lot of good, stable jobs that, for the foreseeable future, I don't see them being downloaded. I don't see them being automated. I don't see them disappearing. Again, 20 years later, who knows? But for the time being, it just seems like those jobs aren't going anywhere. And, FedEx made it their global headquarters because it's the most centralized location for them to get to where they need to for their shipping. So, that made a lot of sense to us. And then, I looked at the housing stock. There was a lot of old housing. There wasn't a lot of new housing coming back because it gets older and, dilapidated. And then I also looked at the price per square foot. So, between those factors, I mean, I was looking at, well, the last building we bought, it was 178 units. I think we paid under $30 a square foot for the building. So to put that into context, once we renovate it, we'll be into it probably for 50, maybe 55 a square foot. To build that from scratch today, you're over 125 to 150 plus the land. So, these were some of the factors that I looked at, whether it was Tennessee, I also like Florida. These are at a high level, these are some of the things that kind of give me confidence in a market.
Wow. And so let's get to the Canadian part of things. So
Sure.
what, when you got into it, when you started getting into the US, what are the differences, or what do you have to do as a Canadian to get into the American market?
Wow. Well, it's a big question. I mean, there's a lot of things you need to do. I mean, first and foremost, you need to have. So I guess the best way to start answering that question is it depends on if you're investing alone or if you're investing with a bunch of partners. Because if you're investing alone, then your decisions are yours. The burden of reporting or taxes or accounting, legal, that's kind of on your shoulders. If you have partners that you're bringing in, whether they're passive or active investors, you need to be very mindful of how you conduct yourself, because there's implications not just on you, but on the entire group, so to speak, right? So I think the first thing people need to be very clear on is, number one, are they investing alone, or are they investing with other people, whether passive or active? Because that will take you down a different rabbit hole right out of the gate. Number two is, when you do go down to the US, you need to be very clear on the fact that you're technically operating, I almost look at it as two businesses, because the Canadian side is its own thing that is accountable to the US, entity, right? And again, I'm overgeneralizing, but that's really important. Also being very clear on the state that you want to invest in and the type of assets you want to invest in. And, those are all, most of these things happen concurrently, but if you line them up, that's what they are. My number one recommendation would be that if you're investing on your own, have your entity and your structure and all that stuff set up even before you buy your building, or even before you put an offer on a building. Because what you'll find is, you'll you'll go to the US, you'll tie something up, and you have 15 days, 30 days, whatever it is, and then you're just hammering away at trying to find an accountant and a lawyer and all this stuff. And the problem is, if it's your first go, just getting those people in place to agree to work with you and figuring out your terms, making sure you're reporting the right way, like all of that, you don't want to be doing that while you're trying to do due diligence on the thing that you're actually trying to buy.
Mhm.
So that's really important. Also, once you have your structure figured out, it's also different if you buy cash or if you buy with financing. You know, if you're buying as a in the U.S., they the American rules. So I was down in the U.S. We were buying back in 2010, 2011. We had a limited partnership. We were buying strip malls in Arizona. So you remember when the world crashed 08, 09 and things were, our dollar was really high. We put an LP together and we went down to the US, and getting financing as Canadians then was a different conversation than it is today. Today, they call you, maybe they called us that before, they call you a foreign national. And from what I could tell, whether you're from Germany, Canada, or Chile, they really don't care. You don't have any history in the country as a foreign national. If you don't have credit there, you're starting at a different place than, which is weird, right? Because we think Canada, US were kind of the same, but that's not the case anymore for financing.
Oh, and it used to be before.
Well, I don't know if it was easy, but it was definitely easier when we were down there back 10 plus years earlier with another LP that I had. It just seemed like there was less maybe red tape is the right word. And I don't know how much of that was as a result of the whole financial meltdown and the all that stuff, but it is a different story. It is possible to get financing as a foreign national. You just really have to get your your ducks in a row. You're not going to get down there and get, from what I can tell, you're not going to get down there and get 3% down FHA loans, which is kind of like the CMHC.
Oh, okay. So then, so let's say talking about financing, um, and yeah, as a Canadian financing, so what I guess are the differences? Like, what do you have to do over there to get your financing? I guess comparing it to here. Like, do they have the same here where we have, you can get residential mortgages and
Mhm.
then it is on your income, or you can get commercial loans?
Oh, I see what you're saying.
Yeah, like, do
No,
they have similarities like that, or how different?
yeah. So Diana, the underwriting is identical on the property. What I'm saying is that you're already starting. Imagine you moved to Canada today as a new resident, new landed immigrant, and you had no credit in the country. So are you going to be able to go to CMHC and get a 95% first-time home buyer's mortgage? Maybe, maybe not. You don't have the credit, you don't have the FICO score, so one of the things people could do as Canadians, if you're serious about the US long term, is start to establish US credit facilities, like a US credit card. Just start to build some credit history in the US. That's actually literally one of my friends, actually a bunch of my friends that have summer homes in the US. That's what they do. They have US lines of credit or US credit cards. So through RBC or TD, they have the cross-border programs where you can at least start to hit the radar and establish like a FICO score. Because your Canadian scores don't mean anything down there, technically, right?
Yeah.
So that's a big one. The other thing too is as a foreign national, because you don't have credit history, your loan to values are lower and your interest rates are slightly higher.
Okay.
So
But is that would that be the main yeah, I guess, but then also your score. So if you don't have a credit score at all, then your chance, like, it's probably better to go in as cash, I guess. Like, is there any chance to be able to get a loan?
oh yeah, there's definitely chances to get loans. I mean, like anything else, you got to build a track record, right? I mean, it depends on what your viewers are looking at doing. If you're buying a, $60,000 house in Ohio, then you should be okay to go in that thing with cash because, at that level, you should be okay to make that kind of a commitment. But if you're talking about buying a $3 million building all cash, well, you may or may not be able to do that, right? So getting financing is possible. And actually to that end, so if you look at the commercial side, it's just like Canada and just like most places. They look at NOI, they look at replacement costs, they look at the track record of the management team. So all those things matter. But all I'm saying is that at the end of the day, when it comes down to it, if you go to a conventional lender, if you're a foreign national, that's a different box that they have to check, which then puts you down a different funnel of credit products that are available to foreign nationals,
Oh,
right? So whereas if you're an American, like Andre's brother, and if you're an American and you have, history there and all that stuff, and got a good track record, then you're going down a different credit box
mhm.
because you're an American.
Yeah. Yeah, which makes sense. Let me see. Does anyone have any questions so far that they would like to ask? Feel free to unmute yourselves, or I can ask the next one. Going once, guys? Going twice? Okay, I'm gonna ask the next one then, I guess.
Let's do it.
So when it comes to, let's say, the corporation side, is, I guess, over there you would always recommend to go in a corporation sense or whatever, like a limited partnership, to buying a property over there as a Canadian. Is that the best way, or is that again related to how you decide to run your business?
Yeah, that's probably a pretty big question to unpack as well. But essentially, what I gather in the U.S. is that it's a lot more litigious than Canada. I
Mhm.
mean, if you remember years ago, there was that guy that sued McDonald's because his coffee was too hot, right? So, that came out of the U.S. I mean, I don't know if Canadians are that creative or that cunning. So, from a litigious standpoint, you always want to have a corporate shield. For an American, the default answer is always put your building or your buildings into an LLC, run it that way, you're good to go. For Canadian, it's not so simple because you have to address the cross-border issue with the IRS and the CRA. So again, it comes back to whether you're investing just your own money for your own sake, for your own, goals, or if you have people coming with you. And if you have people coming with you, you have to be mindful of the fact that not everybody is eager to file US tax returns, right? So, for example, in my limited partnerships, when we go cross-border, we have both Canadian and US investors in our various, actually, some buildings are just Canadians, some are Canadian US. And in either circumstance, those Canadian investors, one of their biggest selling features is not to have to file US tax returns because they don't want to be in the business of the business. They're passive. They're just putting in X amount of dollars. They want to own a part of an apartment building. Um, it's an investment for them, no different than other things, right? So they don't want to file. So there's ways to mitigate that where you can just keep your investors kind of on the Canadian side to make it easier for them. And then there's other ways where everybody files in the US. What people need to be mindful of is how you structure yourself on the US side has a direct impact on how things are viewed on the Canadian side. So things like double taxation, you've probably heard the horror stories of that. Um, Guarantees for financing, all this different stuff. Like it's all a function of how you structure yourself. And I can tell you that for a Canadian, an LLC, especially if you have other people involved, is not always the right answer.
Okay. And so okay, Andre has a question. Do you want to come on and ask?
Yeah. So in terms of getting assistance in determining how to structure, do you have an accountant on the Canadian side and the American side that both understand both taxation laws?
Sort of. So the Canadian accountants will always tell you that, they have a proficiency in US, but they'll tell you, here's my experience, Andre. Yes, there's accountants that are sometimes dual licensed, but in almost every set of circumstances, they'll tell you that their actual practice is US based or Canadian based. They typically have the cross-border capacity, but in my experience, they specialize in one or the other. Same thing with lawyers. Just because the law and accounting things change, that being an expert on both sides is difficult. So to your point, yeah, we do have, in our circumstances, we have Canadian tax advice, Canadian legal advice, U.S. tax advice, U.S. legal advice, and we do things that way. Uh, Maybe it's a little overkill because we have third-party money. We have partners, investors. So we want to make sure everything is, cross-checked as thoroughly as possible. But even for your own purposes, if you're going down on your own, getting somebody on the Canadian side that has an understanding, or has, at the very least, has clients that also have US assets that they have to repatriate or migrate back to Canada is a huge leg up. But I would still recommend that you have somebody in the US actually deal with the day-to-day stuff in the US, because it's too much. The rules, they change. I mean, I don't know if you've ever seen the the Income Tax Act in Canada. It's, and then the CRA IRS, like it's a lot.
Have you ever had any sort of, or heard of any type of conflict that way with, like, your American accountant is telling you one thing, but your Canadian is telling you another thing, and how do you kind of deal with that?
Yeah, you have conflict on a daily basis amongst those people.
Okay. So it's common.
Well, it's very common. What you do, Andre, is you always err on the side of caution. I may be aggressive with things personally, but I'm typically not aggressive with other people's parameters. So that's kind of my thought process. The thing is that you always want to take a position that you can defend to the CRA or to the IRS if need be. And there's plenty of history there between cross-border stuff that you can lean on. But yeah, do accountants have their own interpretation? I mean, yeah, of course. I mean, I bet you your accountant in Canada would have a different interpretation than Diana's accountant or my accountant, or they all have different interpretations. That's why they make you sign that little sheet at the bottom that says, it doesn't matter what I tell you, it's your fault, right? So
Gotcha. Okay.
but yeah, you essentially look, you document why you do what you do and how you do it. And if you're acting reasonably within the context of the advice you've been given, you should be in the clear.
Okay. Thanks.
Thank you for the question. That was awesome. So anyone else? Let us see if there's anyone else that has a question, or I'll continue. Okay. So the next question. So talking about, I think we'll maybe do houses first and then going more to the multi-units because there may be differences there. What are the expenses that we can expect to see when purchasing a house or a multi-unit?
Well, I mean, on the housing side, I mean, a lot of it is, at the risk of sounding repetitive, a lot of it is very similar, Canada, US based. I mean, the major difference, I think that you would, I think people spend more. Well, there's another party involved on the US side. You typically have titles. You have title companies that clear titles for you. I know my legal expenses tend to be a little bit higher on the US side. And I think that's just by the very nature of, maybe the US being a little bit more litigious. I mean, it's not so much more that I'm just looking at it like, oh my God. But I think the best thing to think about is on the multifamily side. If you're going to operate in a multifamily capacity, you need to be very cognizant of the fact that, if you're going to write on a deal, you need to be prepared to spend, a couple thousand, maybe $10,000 on that property and still be willing to walk away. That's probably the biggest thing. So, I mean, we were looking at a property in the fall. This one, I was talking to Vedran about it yesterday, where we tied something up. It was 80 doors, I think it was, and the price seemed very attractive. But in due diligence, when we pulled the records on the property, we realized that it was bought cash, and 6 months later, the guy was trying to sell it for essentially what he paid for it, which to me was a little suspicious. Why would you go in strong, buy something cash, and then 6 months later, mark it up maybe next to nothing and just want to get rid of it? So, in the due diligence, we spent some money, spent some time. One of the things that a lot of people avoid doing is checking the sewage. The guy that bought it before us did just that. He didn't check it. We snaked it. We ran the analysis on the sewage system there, and it turned out that the sewage line was cracked to the main city line, and it was cracked to the point where you actually have to excavate right over the main road to the city line where it connected. and that would have literally shut down traffic, would have closed I think it would have basically doubled our purchase price right out of the gate. So there you go. That was I think it was $800 that we had to pay the guy to snake it, to figure it out, and you know, it was well worth it, right? So I think Diana, it's not necessarily as much about knowing what to pay for; it's knowing what to pay for first, right? Because a rookie would have gone in there and just gone through his checklist and said, okay, I need a phase 1 environmental, I need this, I need that. But there's certain neighborhoods, certain areas that have a propensity to certain issues, right? So for us, that was one of them. And, you know, making sure that that wasn't, you know, because we would have paid for an environmental report and then eventually figured out the same thing, right? So.
Okay. And so talking about that, how do you decide, I guess,
What you do first?
yeah, or just like, or even know you're basically talking about that, you know, knowing the certain areas and, you know, if they're known for certain things, like how do you even find out about how certain areas, you know?
Well, I mean, it's largely, you know, you know how I learned not to touch the stove as a kid? I touched the stove.
Also,
I learned.
in a previous, I guess, that you had some sewage issues, and then it was something that you always wanted to check for afterwards.
Well, I mean, there's you gotta look at, yeah, a lot of it's experience based. You know, the other piece that you need to be cognizant of is, where was I had another story I was gonna tell you, but like there's certain indicators that give you an idea of what's going on. So for example, another property we were walking, we actually wrote on this one too, and this was 140 some odd units, I think it was. We walked away from this one. We knew that this one was going to have environmental issues because we saw where the drainage was draining. We saw where the water was draining from, and they had some of these buildings are in really bad shape. So, you know, cosmetic we can deal with, you know, minor structural we can deal with, but there's certain, you know, roofing, you know, paving, parking lots, cosmetic stuff, you can deal with all that stuff. But when you have sewage from the bathroom flowing from the second floor out the property line, you've got a pretty good idea of what's happening there and how long that's been there. So, you know, rather than spending the money to pull that phase 1 environmental right then and there, you can ask the vendor to comment on this deficiency and when was the last time they had an environmental done on the property, right? Because what it does, it establishes your credibility with the fact that you know what you're talking about with the vendor. And another thing it does is, if you do want to come back and negotiate the purchase price even more, you've got another thing in your corner, right? With that property in particular, there were just a few other things that we found. The vendor started becoming very unresponsive to, you know, our questions. So we just said, you know what, thank you, no thank you. You know, another property, the realtor told us that the sewage was in great shape. You know, the water was running perfectly fine. By the way, water's your worst enemy. I hate water more than fire, because fire you can deal with. Fire, you know where it is, you can deal with it, you can address it. There's no secret fires happening at the property. You know, you know there's a fire. With water, you have no idea. And there was another property, the sewage wasn't draining properly. He was telling us it was perfect. So we waited for a rainstorm. We drove by the property a day later. Sure enough, there was a pool in the parking lot. Came back 2 days later, the pool was still there. It took 4 days for that pool finally to drain.
Oh, wow.
So, you know, it's experience, right?
Oh, wow. Yeah. But that's interesting because, I mean, in Canada, you know, you do environmental tests too, but it's more, I feel like it's more than you're saying by experience of dealing with multi-units. You just start maybe doing different kind of tests that are not, I guess, not as expensive to start off with, I guess, before getting to the environmental tests.
Well, a lot of things you can do is you can just ask in due diligence before you spend the time. Like, for example, knob and tube wiring. We used to do a lot of work in Winnipeg, Canada. We would buy small multifamily there. This is back in 09, 10, I think it was 11. And, knob and tube wiring is a huge risk, as I'm sure you know, right? So, we would literally, upon in due diligence, rather than spend the time or the money, any knob and tube in the house, right? So it's just one of those things that, you want to know earlier on. Lead paint, because you got to remember some of the buildings we're buying were built in the 60s or 70s, and some of them haven't been, haven't had a penny spent on them since.
Very true. Yeah.
Yeah.
That's actually, to be honest, one reason why I like doing the full guts. Because, for example, like that our current build that we're working on right now, our current house that we're working on, I mean, it looked like it didn't have any knob and tube, but we were already going to fix all the electrical anyways. We were going to rip it all out and do it all over again anyways. But it was funny because we opened up walls and there was regular, wires going into knob and tube, and we're like, wow, thank God it was already in the budget anyways. And we were planning to change it because they were in the middle of a gut, and I guess it didn't go past that. But yeah, it's very interesting when, those kind of things come up.
Yeah, and if you've built in a full gut anyway down to the studs, then you're mentally already there. You've already priced it in. And that's fine. I'm not trying to talk anybody out of doing full guts. I mean, one of the projects, yeah, it's been literally a full gut value add. So if you're going in there with that mindset, that's fine. But if you think it's just going to be, a turnkey rental property or something like that. And something else too, depending on where you're buying, and this is why people need to be so careful. There may be rules that change as soon as the property changes hands. I remember I was looking at a small, it was 20, 30 unit, I think multi-fam in Winnipeg at the time. And for whatever reason, there was a rule that if you changed ownership, I had to do an extensive series of improvements on the property that were only required the second that property changed hands, regardless of if they were required or not. Practically, for the safety of the building or anything else, it doesn't matter. As soon as that building changes hands, here's your bill for another 50 grand or 75 grand. So, being very cognizant of those things is, again, touch the stove once or twice and,
you learn your lesson, right?
You learn your lesson, yeah.
That's all. Yeah, it's very great. Yeah, you're right. So there are quite a bit of similarities in Canada and the US. I guess the main one is what you were saying, let's say deciding what kind of investor you want to be and how you want to structure it on Canada and the US.
Yeah, the biggest I guess advice, the biggest wisdom I would share with anybody here is don't dabble in the US. You're either in or you're out. Because and actually let me reframe that. If you want to just dabble in the US, do it with someone else. Don't do it on your own because it's too much work for one property. Like, it's just too much work. It's not worth the mental consternation trying to figure out how to now file with Uncle Sam and having to deal with another accountant and another lawyer. And, what about the conversion rate? Because you got to think about that now. Materials, rule changes. Like, it's not enough to want to warrant, in my opinion, it's not enough to warrant that work for, one house. It's just not. So if you're going to do it actively, have a plan to build, a portfolio worth your time. But if you do want to dabble in it, you want exposure to it, then find a group that has everything set up for Canadians and just co-invest with them. It's simpler. It's you don't have the stress of it, right?
Yeah, great point. And it's just like you said, like it gives you the opportunity to decide if this is something you want to go full on or not. And at least you have someone that already comes with the experience, which is, I think we're always talking about. It's always great to have a coach or a mentor. And if you're investing with someone that's already in it, then I mean, they're gonna naturally, it probably comes up that you're getting mentored in while the process is happening, or you're just learning, as you get status updates or whatever, depending on I guess the level of involvement. So yeah, that's a very great tip.
Yeah, well, I have partners that don't even know what state we're buying buildings in. And I have partners who want to learn the business. So it just depends on, where somebody fits, it fits in that parameter, right? And I mean, it also depends on the kind of investor you are, right? I mean, I know a lot of people that are quite comfortable investing just for gains because cash flow is not important for them. I also know people that, like myself, regardless of net worth or whatever it is, you're always looking for cash flow. And cash flow based investing for me has always been, it's what's taken me, to the markets that I've been in because I'm not scared to invest outside my backyard. And again, whether it was Winnipeg, Arizona, Tennessee now, Florida, I've taken a very disciplined approach at the market. And if you can buy stuff for $30,000, $40,000 a door compared to 400,000 or 500,000 a door in other markets, the rents are lower, fair enough, but your gross rent multiple, the period it takes to pay back the gross rent to the purchase price is just so much smaller in those markets, right? Which for me made it worthwhile. But would I go down and do everything I've done just to go buy a duplex in Ohio? No, it's too much.
Yeah, which makes sense. The amount of learning and everything that's
Oh
required,
yeah.
and just for the one, you're
No, no, no.
yeah.
If you want excitement, go to Six Flags. Like you don't, buying a property in the US, if it's just something you want to try, like even I was talking to my accountant a few days ago. One of the biggest problems Canadians have, here's something else, is they buy a vacation property in the US and they don't even consider it an investment property. I mean, investment in the technical sense. And then, they buy a house in Florida or Arizona and it's gone up crazy in the last 10 years. And maybe they sell because, they're no longer interested in that market. Without proper tax planning or structuring, the IRS immediately withholds, I think it's a third of that purchase price.
Oh, really?
Yeah, and then you have to deal with it. And don't ask me what deal with it means because I've never been in that situation. But I think you now need to go back and prove to them that, yeah, like it's a mess.
Mm-hmm. Oh, wow. Yeah. That's so if even if their people want their vacation homes, make sure they know everything
Oh
about
yeah, structure it accordingly. Think it through up front because people are impulsive, right? They buy some. I mean, fair. You think Canada, US, it's the same thing. Whatever, just across the border. I've got plenty of friends that have literally bought properties in the US just recreationally, and they're surprised when there's a 30%, I think 25 or 30% mandatory withholding right out of the gate.
Mhm. Oh, wow. Yeah, that's definitely good to know.
And then I actually don't remember what happens on the Canadian side because I've never done this, but I wonder if you get double taxed then because the CRA sees the other money coming home after the IRS took their pound of flesh. Yeah, it's interesting.
Yeah. Yeah. Well, actually, that was going to be my next question, or maybe making sure I don't, if I understood it properly, because it sounds like in general, to make sure, I guess you're meeting both sides. Like if someone only doesn't want to get taxed on the US side because they're, let's say, a passive partner. So do you structure it, you have like a corporation, I guess, on the Canadian side that goes,
So to be clear, everybody pays tax on the US side. It's just a function of who pays it and whether you can get a credit for that on the Canadian side. So if you're investing in real property in the US, you will pay US tax. The only question is whether you can get a credit for that from wherever it is that you're investing from. That's the real issue. So for example, with us, what we do is we have our Canadian entities act as the aggregate US tax filing entity on behalf of all of our investors. So, US taxes are paid, and a portion or a very large portion of that is a credit against Canadian taxable consequences that, to your point, Canadian investors through us don't have to deal with.
okay.
So yeah, there's ways to do it. And I kind of just said a mouthful, and there's some steps to it, but essentially, U.S. taxes are always paid on U.S. property. It's just a function of if you get consideration for that on the Canadian side. Because if you don't, then you're right. Then there's the double tax issue. Because the CRA says, yeah, we don't care.
Mhm.
So, for example, the CRA doesn't recognize an LLC.
Okay.
They don't recognize it. There is no such thing as an LLC in Canada.
Yeah.
So they don't recognize it. So whatever you deal with within an LLC, you need to make sure your accountant structures things properly so that you don't have the double tax issue.
So a lot of learning. So I feel like the
But
best thing to do is to first go with someone that knows, to
I,
at least get the basic structures of everything understood. If you're, because going it alone seems quite complicated, to be honest.
I mean, it's like anything new, right? If you're going to go at it alone and your intention is to continue to do it, look, it'd be no different than, you know, your business or doing renos or flips or private lending. If you just intend on doing one reno or one flip, one private loan, then that is a tremendous amount of energy to spend on something that you're never going to do again,
Mhm.
right? So if you feel like, you know, for me, the US investment proposition made a ton of sense because I can't buy a parking spot for $30,000 or $40,000 in name a city, Canada. You know, I'm buying entire apartment units for that price in the US. So for me, the value prop was tremendously compelling, and it was worth, you know, the mental, you know, anguish to figure out how to do it. No different than if you're going to do wholesaling or private lending or whatever it is. If you're going to do that, you know, consistently, then great. It might be worth going through the fire to figure it out. If you want exposure to it and you don't actually want to, you know, blow your brains out trying to figure out which way is up, then yeah, you're right. You know, connecting with someone else is definitely the right way.
Okay. Yeah, great. Andre, you want to ask your question?
Can you repeat how much you said you're buying apartment buildings for?
Yeah, see? So uh, I bought one pre-COVID. So just when COVID started, I bought one. I paid 25 a door, I think. 22, 25 a door. Call it 25 a door. We'll do about 15 in renos, and it'll be about 40, 45 once we're done with everything else. Replacement costs for those are about 85 to 100 to build them new, basically, plus the land. And then post-COVID, we closed something April 1st. It was 178 doors. We paid close to about the same, 20, 22, 24 a door. And we'll probably be into it about 40 a door once the renos are done, if we don't flip it first, because we're getting crazy offers to just sell it now. So yeah, they're out there. I mean, COVID is obviously pushing prices up everywhere across the board for everything. But even if we're paying 40, 50 a door, you know, that same inventory in Canada is easily, you know, I'm trying to underwrite a deal in Calgary right now because this is home for me a lot of the time. And, you know, I'm easily looking at 3 times that, if not 4 times that. And the rents aren't 3, 4 times higher. That's kind of the point.
And are a lot of these deals like off market, or are they like, do you find them on MLS type of thing? Are they pretty standard
Well,
or mixed?
multifam, yeah, yeah. So, I mean, if you're looking at, depends on what you're trying to buy. I mean, multifamily, as you guys probably know, isn't really an MLS game anyway. Multifamily is typically private, you know, realtor. If it does get sold through a realtor, he typically has 3 or 5 buyers, or she or he has a bunch of buyers that they know can close, and they just literally find deals and then just call them to the private buyers. Maybe they'll list it on the website or whatever, but it's not bigger multifamily typically trades moves in silence, so to speak, with, you know, a few people being able to bid. But the smaller stuff, whether you're buying a house or eightplex or whatever it is, yeah, I mean, look, it's on Zillow, it's on Redfin. You know, you got wholesalers knocking doors. Like you can buy, you know, like in Memphis, for example, you can buy houses for 10 grand still. You know, they're in really bad shape and they're in neighborhoods that you probably don't want to be in. But, you know, if you find those houses on the periphery of areas where guys like me are doing the bigger renos, then those are good value plays. So, yeah, but MLS is not, yeah, for the larger deals, that wouldn't be where we would be finding those typically.
So you're probably like in specific, I guess, real estate communities, so that you know who are the people like that, the wholesalers and things like that are selling in those areas.
Yeah, well, one of the deals we did, we literally had the lender give it to us. The lender literally called us, says, "Hey, I have this, beat up property, pain in the ass, right? And I got that the owner, actually, in fairness to him, he had some serious health complications and was losing his wits about him and started to make some really questionable decisions. And the kids and the family wanted nothing to do with it, but the lender was worried that they were going to basically, destroy the value of the property further than where it had gone. So we had come in, we essentially took over the note. We wrote a check to the vendor, for some consideration to just kind of, walk away clean. And that was one of the deals. Another one of the deals we actually knew, to your point, Diana, we knew the owner through a real estate club. And he was a gentleman that, old seasoned guy in real estate, knew what he had, just didn't, just didn't want to do the work. He was tired, made his money. He wanted to 1031 out of the property into something else. And, we helped him do that.
Great. So who wants to ask the very last question? See if anyone has any, wants to ask the last question. Everyone's very shy today. Although, I mean, I feel like you've given us so much information that a lot of us are going to have to absorb and
yeah, sorry about that.
No, I mean, that's good, right? Because that gives us a lot of things to think about and, like that make decisions and learn, because there's always, it's always different. There's so many differences. And I mean, I think the basic is always finding the right team to help you. Nicole, you want to ask your question?
Hi, yes, I do. Thanks everybody for organizing and attending today. Everything's been super helpful. I just wanted to, I'm pretty new to this whole deal, especially in the States. So wanted to know what you said or what you meant when you indicated the previous owner wanted to essentially 1031 out of the property.
Oh, right. Yeah, that's my slangism. I get called out for that. I noticed Vedran actually wrote 10. So 1031 in the US is a tax exemption that it's a tax deferral exemption where somebody can essentially sell a property and roll the the proceeds into another property on a tax deferred basis. So we don't have that in Canada, but they do have that in the US. Something that's also, Nicole, I don't know if you're Canadian or US based, but my understanding is that Canadians investing in the US have a very difficult time utilizing the 1031 because it's not recognized by the CRA as a tax deferred mechanism. So in other words, if I took an apartment building in the US and all my investors were Canadian, and I 1031, I sold the property and then rolled all the profit and cash into another property. My understanding is that as a Canadian, as on the US side, the IRS says, oh, okay, we understand this. This is a 1031, you filled in the blanks. Okay, here you go. On the Canadian side, my understanding is the CRA says, yeah, that's cute. We don't care. Where's our money? So.
Thank you. I'm Canadian. Can I ask one more quick question?
Yeah, go ahead. No problem.
Okay, thank you. It just dawned on me. I heard about 6 months ago, I guess, that, and again, this isn't necessarily American topic for real estate investing. However, I think it's kind of linked because I know in the States, like you mentioned, we have tax obligations, but we also have tax exemptions over there, right? Say on a personal level. But I know here in Canada, our primary residence is not subject to any capital gains right now, nor do we get any tax exemptions. But has anyone heard that the CMHC has been commissioned by the federal government to investigate taxing on equity of primary residences?
No, I've not heard that. I feel like that.
You mean in Canada here?
Yes.
Oh yeah. Well, I mean, without getting political, certain parties have been trying to tax your personal residence for quite a while now.
Okay.
I don't know how far down the path they are, but I think a year ago or 2 years ago, they made it mandatory to report on your tax filing any sales of personal residences, if you remember that as well. That started maybe 2 years ago. So, are they thinking about how to get access to more revenue? Yeah, I think they are. I don't know how that's going to go over, but yeah, they certainly tried it.
Thanks again.
Yeah, I hope they don't. I hope. I mean, if they start tax, well, they were hinting at, what was it? I don't know if you remember, Diana, but they were trying to get like a 25% tax on your house or something like that. I don't know if that's a popular thing to say if you want to get reelected, but it wouldn't shock me if that was something that they seem to be moving in that direction, which is unfortunate.
Oh, really?
Well, I mean, why are they, think about it. They're asking you to report. Again, I don't intend to get political here, but they, why are they all of a sudden so interested in you reporting the disposition of your personal property on your tax return?
That's
right?
true.
Like, it's a mandatory reporting requirement now. So,
Yeah, that was definitely a red flag for me. I know they've mentioned, well, we're just trying to lower, the degree of foreign nationals investing here, like having empty buildings and things like that, or empty rental units and stuff. But I just don't buy it. Again, don't want to get political.
Yeah, I think there's other ways to track that, but it serves as a convenient narrative for sure.
Thank you so much, Marcin. It was really awesome to have you on. And I know you have your mastermind coming up. Do you want to tell everyone about that?
Yeah, sure. So in addition to, being in the trenches and buying property and doing deals, we run a mastermind every few months. We're doing one next Saturday called How to Raise Capital for Real Estate. We did one back in May, and we just had a lot of demand to do it again. So we're going to be doing it again next weekend. I found that a lot of people, even after they learn how to do a deal or, do the analysis and, they buy a property, they buy two, everybody hits a wall with, capital. And, the days of buying $10,000 houses and getting $500 net cash flow are kind of gone. So you got to figure out how to obviously get creative, find joint venture partners, and just be able to do more. So, raising capital is a huge skill set. I spent, we always raise capital. I've sourced over $250 million so far. And I mean, I spent a lot of time in private equity, so I feel like I'm kind of a good person to, speak on that. And yeah, the event is, we charge like $97 for it, but that's just to make sure people are actually serious. There's a promo code, Diane. It's MD Capital. It's in the chat box. If anybody wants to sign up, it'll be half price. And yeah, it'll be a full day. We had veteran, we have 60, 70 people registered so far, I think.
70, and there's still stuff rolling in.
Okay, well, our Zoom capacity is 100, so when we hit 100, that's what it'll be. Unless you want to figure out how to increase that, because I'm not doing that. Yeah, so that's the event. We'll be doing that next Saturday, and if you're building a real estate business, I think you'd really enjoy it. So
it's definitely a very important topic. Like you said, when you're building a business, I mean, it's very important to know how to raise capital, because that's just how any business is done. Doesn't matter, real estate or whatever.
And number one reason businesses fail is they run out of money.
100%. Thank you so much. Any contact information that you would like to provide if anyone wants to get a hold of you, either for the event or just to chit chat with you?
Yeah, sure. My email is, I'll just type it in here. It's md@marcindrozdz.com. If anybody wants to reach out to me about anything, feel free to. It's kind of the weekend right now, so I won't be checking it today, but I'll be back at it here on Monday, obviously. I just typed it in there. So if anybody wants to reach out, any questions, get involved with the events or whatever it is, happy to have you guys.
Awesome. Thank you so much. Thank you everyone for joining, and we'll see everyone at the next episode of Ask the Experts. Thank you so much, everyone. Bye.
Thank you. Take care.